Okay. So I was saying that risk appetite is basically how much of risk management is willing to take. And I was mentioning a story of one, I think his name is Adoboli. Yes, Adoboli. One trader in one of the banks, prominent banks in the UK. The issue bordering that case was more around risk, right? I think he decided to take a very, very extreme risk position in order to make a lot of profit, and things didn't work out. So yes, you can, to make more profit, you must take more risk, basically. So that's what risk appetite is all about. Okay, so let's talk a little bit about the approaches, to risk, or a risk-based approaches, basically. Initially, we talked about risk management and how to manage risk. So a risk-based approach is often used to describe the risk management process. It's basically how risk is managed and evaluated. How risk is managed and evaluated in order to ensure that it's mitigated effectively. So that's the most important thing around having a risk-based approach. And my second point, I said the risk-based approach takes the view that some risk must be accepted, but risk exposure should be kept within acceptable limits. Decisions should therefore be based on the consideration of both expected benefits and the risk. So you have, so a risk-based approach is basically, how you manage your risk, how you assess your risk. And the process of assessing risk is sometimes called risk profiling or risk mapping. And when you are doing risk mapping or risk profiling, two important things that come to mind. You need to assess the probability of the risk and the impact of the risk. You need to assess the probability of the risk and the impact of the risk. Two key things, the probability of the risk and the impact of the risk. So you need to know how frequently the risk occurs, and if it occurs, the damage it causes. And a risk map helps you to do that very effectively. So if you have a question which is bordered around risk management, risk assessment, you can easily use this simple risk map to analyze your risk. So you have, like I said, it's based on impact and probability. So you have on the Y, which one is Y and which one is X? You have on the Y-axis, you have impact, and on the X-axis, you have probability. You have low probability, higher probability. So let's say if you have a high impact risk but with a low probability, what you do is you consider transferring the risk. And what that means is that you seek other control measures like insurance. That's when you move the risk to somebody else to manage, because it has a high impact and a low probability. However, if you have a risk that's a low impact, low probability, You just need to review it periodically. It doesn't cause much harm. If you have a high impact risk with a high probability, you need to take immediate action to control the risk. Whatever risk strategy you have to use, which we'll be talking about in a few slides soon, you need to take immediate action to control the risk. If you have a low impact and a high probability, a low impact, high probability, you also need to take some action as well. You also need to take some action as well. And like I said, as we go on, we'll see some of the actions you can take to mitigate the risk. Okay. Yeah, so okay, so let's talk about the approaches to managing risk first before we move to anything else. Before we move to other things, let's talk about that first. So these are some of the actions I was talking about that you need to use to manage risk. These are some of the actions I was talking about. So first of all, you could do what we call, you could diversify the risk. You could diversify the risk. And that's what a lot of people do. That's what a lot of people do. You can diversify the risk, which is also called spreading the risk. So for instance, when you buy a mutual fund, you are trying to diversify. Or when you have, let's say, 100 Ghana cedi and you put some in savings account, put some in, a small business you are running, put some in another different investment. What you're trying to do is you're diversifying. By diversifying, to bring the risk to a minimum possible. Minimum possible. So the whole purpose of diversification is to invest in a range of different business activities. A range of different business activities in order to overall mitigate your risk. That's the purpose of diversification. It stems from the principle, don't put all your eggs in one basket. Don't put all your eggs in one basket. Very, very important. Very, very important. Don't put all your eggs in one basket. Don't put all your eggs in one basket. Very, very key. They also have risk transfer. Risk transfer. Risk transfer. So when you say risk transfer, what do you mean? It means you are passing some or all of the risk to somebody else, to another person. You are passing some or all of the risk to another person, which is very, very interesting because that's what sometimes we do. And a typical example is buying an insurance policy. So sometimes when you insure a car, what you are saying is that when I have an accident, it means that the insurance company will literally have to take care of, take care of the bills, basically. There's also the situation of risk sharing. Risk sharing. So you can also share risk as well. Basically, you are collaborating with another person and taking on the risk jointly. That's also possible. You can also hedge risk. You can hedge the risk. And hedging risk is basically you make a transaction that offsets the exposure to another risk. you enter into a transaction that offsets the exposure to another risk. So what do I mean by this? A very, very typical example is that when people enter into forward contracts, for instance, forward contracts. So some companies are able to enter into forward contracts where they tell the organization they are dealing with that they will lock the exchange rates because of the fluctuations in the exchange rates. They will lock the exchange rates at a certain price point and trade at that price point. So, for instance, you have, let's say you are a Ghanaian company, you sell clothes, and you deal with a supplier in China. But the Ghana currency is so bad, it keeps on fluctuating, going high and high and high, or going up and down. So you enter into this agreement with the Chinese supplier and say, hey, look, let's enter into a forward agreement. And by a forward agreement, you are saying that at so and so date, when I buy goods from you, you are agreeing today that we would use this particular exchange rate. And that's a way of hedging. You are hedging against the risk that the exchange rate could go against you, basically. Yeah. Then you also have risk avoidance, where you are trying to avoid the risk entirely and not have any exposure to it. They have risk retention, where you have a situation where you accept the risk with the expectation of certainly to make a return. So that's how you manage risk. And these are some of the actions you could take in the risk map I was talking about earlier. Yeah. So the actions that we are talking about in the risk map, these are some of the actions that you could take. I guess I should have moved this in here. Okay. So let's talk a little bit about the role of management and the board of directors in identifying and assessing risk. Yeah. The role of management and board of directors in identifying and assessing risk. So how do management identify and assess risk? What do management do exactly? Management is responsible for identifying key risk. They are responsible for identifying key risk. They're also responsible for designing and implementing the controls. The risk controls. Risk controls are basically the measures that are put in place to mitigate risk or to control risk. They're also responsible for monitoring the effectiveness of these controls. Very, very key. And they're also responsible for communicating, or updating the board of directors on risk matters or risk issues. So that's the role of management. Then we have the role of the board of directors. What are the board of directors supposed to do? They, have a lot more strategic oversight duties. So they are more into setting the company's policy for risk. What will be the policy for risk? What will be the risk guidelines? They will give guidance as to the company's risk appetite. Yeah, so that's basically the role of the board of directors. Very important. Okay. I think we've talked about this already. Risk audit is simply monitoring risk and trying to control it. It's a fancy way of saying monitoring and controlling risk. So when we say a risk audit, you are basically monitoring and controlling risk. But what I wanted to draw your attention to are the stages. In risk auditing. So first of all, it's what I call IARR. IARR. First of all, you have to identify the risk. You can't manage a risk you haven't identified. So first of all, you have to identify the risk. Secondly, you have to assess the risk. You have to assess the risk, which means that you are looking at the risk from a probability and impact standpoint. Then you have to review the risk. In this stage, you are looking at the controls you've put in place to manage the risk. Then when you are done, you report the risk, or you give updates on the risk to directors or to management. So I call it IARR: identify, assess, review, report. Yes. So under risk management, there's a concept called ERM, enterprise risk management, which is seen as a solution, an effective solution to managing risk. It's called ERM. This is where the board creates a very robust framework for managing risk across the entire organization. So, and what this seeks to do is it makes the approach to risk management consistent throughout the company. It makes the approach to risk management consistent throughout the company. So it's a lot more, there's a lot more of some sort of standardization when it comes to risk management across the entire organization. Very, very important. ERM, always keep it in mind. When you are told to give recommendations around the risk issues of a company, this is something you should be thinking about, ERM. And there's a 3-level approach. First, you have to establish the approach to risk management. You have to commit resources to it, and you have to implement the systems for assessing the controls and monitoring them, etc. Okay. So our last bit before we move on to the case study. The case study is the main focus for today, but I just wanted to take time to talk about these few things. Next week, we'll be delving a lot more into financial analysis and financial planning and all that. Yeah. So let's talk a little bit about financial management. You'll be looking at sources of finance, basically. So where do companies find their money, to start their businesses and to run their businesses? And how does the choice of this, help them to run their business? So they are, like we always know, your capital structure as an organization is very, very important. So by capital structure, I'm talking about your sources of finance. You are talking about whether it's short-term or long-term, whether it's adequate or whether it's even debt or equity. Is it debt or equity? Is it short-term or long-term, basically? So organizations choose different strategies, to run the organization. You have short-term funds, and short-term funds could be short-term bank loans. It could be bank overdrafts, which a lot of people might be familiar with. and all that. Depending on the need of the organization, they might engage some of these tools to some of these facilities to run their business. But more importantly, there is what we call long-term finance. Long-term finance, and this could be equity or debt or lease finance. Yeah. So we'll talk about equity a little bit, and we'll move on to our case, basically. So equity finance is finance provided by the owners of the company. It's the owners of the company that invested their money into the business. And it's this money that they use to run their business. So what it means is that they do not have to pay interest on this money because they didn't get it from a bank. But sometimes organizations go further to get money from the bank, and that's what we call debt finance. We'll be looking a lot more detail next week at some of these sources of finance. But I want us to jump into the case for now. Any questions? Any questions? Does anyone have any questions?
No, sir, for now.
Okay. So are we ready for the case?
Yes, please. We are ready for the case.
Okay. Was it Andrew that was speaking?
No, Edu.
Oh, okay. So if someone has the case, can someone volunteer? Because I want to show you how to break down a case and how to do like amazingly well on case study. Case study is not difficult. So I just want us to take it step. That's why I left a lot of time for it. So if someone has the case, I have it here, but to make it a lot more interactive, I want someone to read. Like if someone has the exam paper with them, which is online, certainly. Anyone would volunteer to read? Can anyone volunteer?
Please, is it the May 2020 paper?
No, it's November 2019. It means that you guys didn't look at it.
Sorry, please, I don't have that. What I have is May 2020.
Okay, no one has it.
Kindly check this on the page, May 2019.
It was November 2019.
Yeah, November 2019 is on the page.
Yeah, but would anyone like to read it? That's it. That's all I need.
Okay, I have a paper here. It's plenty though, but should I read everything?
I don't think anyone went through, but what I wanted you to read was to start from okay, so start from page 2, performance of candidates. I just want you to listen to some of the comments made by the examiners before we delve into the question. Performance of candidates on page 2.
Okay, performance of candidates.
Mm-hmm.
The poor performance could be attributed generally to the candidate's shallow answers and poor performance on the financial analysis question.
Mm-hmm.
Interestingly, many candidates who failed did so with marks slightly below the pass mark of 50%. Clearly, candidates' poor performance cannot be attributed to any weakness in the examination itself, but poor preparation on the part of the candidates. I would like to reiterate a recommendation I made in the immediate past, that is May 2019 report, which I believe, if taken seriously by both instructors and candidates, will ensure better performance going forward. It is crucial for both instructors and candidates to intensify teaching and learning in order to perform better in the strategic case study. Specifically, they should endeavor to delve deeper into the concepts contained in the syllabus by reading further from other references as provided in the list of references, and not solely depend on the manual provided by the institute. I also recommend that both instructors and candidates familiarize themselves with various issues bordering on the business environment by reading relevant newspapers and magazines such as Business and Finance Times, Forbes magazine, the Economics, Harvard Business Review, corporate annual reports, etc. Listening and watching general news and business news in particular from the broadcast media. Doing these should enlighten both instructors and candidates about different industries and the general business environment. Both instructors and candidates are also to endeavor to bring their expertise and learning from their courses to bear on strategic case study paper. As I have indicated in previous reports, the new strategic case study paper is a capstone course which integrates all the subject areas in the professional program. Candidates especially ought to go into the strategic case studies paper 3.4 examination against the backdrop that every prior learning from other subject areas is in preparation towards paper 3.4. If candidates fail to appreciate this, I am afraid they will struggle for a long time to pass and ultimately qualify as chartered accountants.
Wow. I think you should also I think you are very good at reading, so you should consider a job on TV or radio too. But thank you. So what I want to highlight here is, you see how the case study is, like the examiner is saying, it's very, very integrated. You need to draw, even though the theory is important, you need to draw your experience from a lot of places, and that's not scary. For me, that's good, because you need to know, for me, you need to know a little about a lot of things, and that can help depending on how you're able to leverage it. So you need to use, a lot of concepts. And the examiner is recommending here that you need to read things like corporate annual reports, Harvard Business Review, Financial Times, etc., because they talk about these strategic concepts. So it's a capstone course, and by capstone, they mean that it integrates all subject areas. So that's how you should look at it. You should look at it holistically, and you shouldn't be afraid of using. Once you work in an organization, you might see things, that would give you a certain experience, and you shouldn't be afraid to apply those experiences to analyzing your case. That's very, very key, So draw from your experiences, from all the courses you've taken in ICA, from your work experience in your organization, as well as, things you've read online in terms of business articles. Draw deep from all these knowledge sources in order to answer these questions. Very, very important. That's why I wanted to highlight. Okay, so can you move on to notable weaknesses of candidates?
Okay. Notable weakness of candidates. Simply put, candidates should understand that every other paper they are studying is a preparation towards the strategic case study paper. Other weaknesses include some candidates still do not write answered question numbers at the appropriate columns provided for that purpose. 2. Most candidates do not number the pages in the answer booklet, even though spaces for that have been provided in the answer booklet, in the answer packet, sorry. 3. Some candidates still refuse to write the answered questions in the spaces provided in the answer packets. 4. Some candidates also mix up question numbers with respect to the questions answered. 5. The grammatical expression of some candidates is still very worrying. 6. Some candidates have very poor handwriting that makes marking extremely difficult. 7. Some candidates write their students' identity numbers at the back of the answer booklet. This makes for easy identification of such students by an examiner. Some candidates' approach to answering questions was done without giving consideration to the mark allocation.
Okay, so
for instance,
can you hold on, please? So because this is a very, very important point. You know, sometimes a candidate will see, oh, this question has been given one mark. 1 mark, no, that's where it's come to tell their own story. The chameleon is going up, the chameleon jumped, and the chameleon is going here. You write a whole essay on a 1 mark question, you know, and for a question that is giving you 10 marks, you write something little. And that's what the examiner is talking about, you know, giving consideration to the mark allocation. Very, very important. You know, very, very important. Okay, go ahead.
For instance, some students could write a whole page for a question which has 2 marks allocated to it. Weak control over the issuing of additional papers. The current system makes it possible for either candidates and/or invigilators to abuse by assisting examination candidates in the examination hall. I don't understand.
It says we control over the issuing of additional papers. Current system makes it possible for either candidate to abuse by assistant examination. Okay, yeah. So it's basically saying that there are situations where basically cheating. That's what it's talking about. That's what it's talking about. Where invigilators and candidates or candidates themselves like connive and assist each other. For example, does it make sense?
Yes, please.
Yeah, okay. Is that all? Okay, I think that's all. So those are some of the concerns. I made AC. Is that your name? AC?
Yes, please.
Yes.
That's my name.
Yeah, I made AC read all that so that you are aware of some of these mistakes, so that you don't have to repeat the mistakes. Okay, so let's move on to the question paper. I'm sure by now everyone should have been able to download it. So, but AC is going to read it. So question paper, let's read, but take it sentence by sentence. Before we start, to analyze a case study, you need solid context. And you need a solid question in mind, even before you see the questions. You know, because usually a pre-seen material will be given to you without questions. So you should be able to, you know, be asking yourself questions as you go along. As you go along, you should be thinking, okay, so what are they trying to achieve here? Why are they making this statement? So you analyze sentence by sentence. And that work, you should have done it prior to the exam in terms of when the pre-seen material comes out. Okay, so let's go.
Okay.
But please read
Question.
it sentence by sentence. Like when you read the sentence, because I would have a comment after every single sentence. And that's the way I want you to think about it when the pre-seen material comes. That's good.
Okay. Introduction. Adolfo Boateng, into brackets, Adolfo, and Kofi Oduro, into brackets, Kofi, met in 2010 when they were both students at the university in the United States.
Okay. So these are two people, two individuals, Adolfo and Kofi. You know, they met in 2010 when they were both students at a university in the United States. Okay, so what questions should be coming to your mind here? You know, you should be thinking, so these are people who want to basically who know each other in the US. They are obviously Ghanaians. They met each other in uni. They probably have built a relationship, you know, a friendship through their meeting from 2010. And you also want to be thinking that these people are people who have international exposure. You know, they are Ghanaians, but they live in the United States. So they have some form of international exposure. Okay, let's go on.
They both had ambitions to succeed in business back in their home country, Ghana.
Okay, so here the case is trying to tell you that these people share ambitions. They have the same ambition. They have the same vision, you know, to try and build something back home. They want to probably use their experiences here in the US to come and build something back home. But one question you should be asking yourself